All right, good deal. So we can see your screen now, Larry, and I'll turn it over to
All right, everybody hear me okay? Yes, okay, great. Sorry about that. It's habit. If you use one system, sometimes you're not as familiar with the others. But anyway, thanks a lot for having me here today, Morgan. And thanks for everybody joining me. If you hear a few bells ringing in the background, the system that we use, we have some audio alerts, so you'll hear ringing and things like that. It's based on maybe a trend line programmed in. Before I get started, this webinar or training session is purely educational. Any stocks or futures that I talk about or discuss should not be constituted as advice and should not be construed as recommendations. So that being said, let me pull up my charts here. And what I'm going to do here, we at PowerCycleTrading.com, we trade, do a lot of options, a lot of weekly options, and do a lot of different option spreads and things like that. So I'm going to show you around what we do and see if I just had a couple of trade setups that I just did. So bear with me one second here. Let me take this slide off. And let me get my other platform up here. Okay, so let's move forward here. So what you're seeing now is our trading platform, and this is my setup for my day trades. So we do day, you name it, we pretty much traded. I've been trading for over 30 years, ran a pretty large trading group. One of actually the largest oil trading groups in the world for about 10 years. And so I've been doing this, started developing my own system and all this about 3 years ago, and teaching and educating people on trading. One of my specialties is options, so I like to trade a lot of options. Weekly options is something I really, really like. Right now, you can see here, this is the NASDAQ 100. I've got four charts here, so breaking it down in various time frames, or fractals, or whatever you want to call it. And here you'll see on the far left, you'll see a 5-minute chart. This is a 400 tick, a 200, and a 133. So what I am looking for is based on our trading system. I'm looking for my lower studies, and then I'm looking at my upper studies here, and I'm looking for what we call cycle lows, cycle highs, and trades that are based on what we call a compression or volatility compression squeeze. So I'm going to go through and show you examples of those. Now right now, my anchor time frame is this far left chart right here, which is our 5-minute time frame. And you can see here that our lower study indicators, you can see, are hard down, but we're starting to flatten out here. And we have these set for customized settings. And if you see these dots here, this is an indication of what we call a compression squeeze. Up here, you can see that the market or price action on the NASDAQ 100 stocks got into that sideways pattern, which we call a compression, or you can call it consolidation. It's trying to figure out the next direction it wants to move. And right here, if you look at the 5-minute, we have these arrows here which signify engulfing candle patterns. So we've got a lot of good information programmed into this system. Now what you're seeing down here is an engulfing bar pattern on the 400, and this is a 5-bar pattern recognition set up here. So the thing is, right now, you've had such a hard move to the downside, the market's trying to figure out, does it want to stabilize and hold here, or does it want to continue back lower? Now, what we will do is we will use this far left chart here, and I have this squashed up because this is really not what I'm executing or triggering off of. This is kind of for my basically what I call the intraday trend. So right now, with this indicator down, the intraday trend is down on NASDAQ 100. The shorter term time frames are trying to bottom out. But what can happen is if you depend on a shorter term time frame, and if you've got a major market move like we've had basically today, we're down 26 points, you can get kind of steamrolled to the downside. So you have to be patient, and what we want to do is we want to wait for our longer term time frame to catch up and show us that the market's actually bottoming out before we go long. So right before I came into the room, my last trade was a short trade. So you can see here we had engulfing candles here. Now also, these are very support resistance levels that are automatically programmed in. So we've got Fibonacci levels. First off, this red dashed line right here is the prior day's low. The line below it, this is based on Fibonacci, and this is based on, these are automatically calculated on here. So this is what we will call, this line here is support 1 off of Fibonacci. It's a Fibonacci ratio. There's support 2 off of Fibonacci, and then we have support 3, which I can pull up and show you, which is further down. And this gives us levels of major support resistance. So here's level 3. So these are color-coded so we know what they are. Now, if this gets broken, this is usually the outlier. This is a pretty big, significant move down. But if this is broken, then we will recalculate these Fibonacci levels. Now, this system here is based on a system I put together about 2 years ago, and then we've just automated it about this year. It's been about 6, 8, probably a year now, using Thinkorswim ThinkScript. So this is on the Thinkorswim platform, but the actual system that we use, if you're interested in it, you can buy the system off my site, powercycletrading.com. And you can just set it up on any platform that you're using, so such as TradeStation, Ninja, eSignal, whatever or Swab, Edge, whatever you're using. So right now you can see that the market is trying to stabilize here, but we're still hard down here on this indicator. So it's not something you want to rush into. We've flattened out and turned on the lower steady indicator. So right here, I am looking at a potential long here. It looks like it wants to bottom out and cycle low. Now, if this does, then I'm looking for resistance right into this 50-period moving average in this R2. So I'm getting ready to take a long signal here on NQ. My other monitor, I've got TradeStation. That's where I'm actually placing the order. So I'm currently long here, and let's see here. I'm going to look for, I'm going to look for my profit take at about 8 ticks right here. Actually, I'm looking for 8 ticks right now. So I've got my profit take set at 35.41.5 right in here, which is right in front of this 50 moving average. So this will be first resistance. I'm just trying to take a little bit out of the market right here. And let's see if I got fill. Yeah, so I'm out. Let's see here. Yep. So what I wanted to do here, since the market is really hard down, I'm just looking to take a little bit out, and I took 8 ticks or 2 full points. So each full point on the NASDAQ 100 is $20 a contract. So that's 8 ticks. I mean, 8 total of 8 ticks. So there's 4 ticks per 1 full point, and each tick is $5. So it's a good contract to trade for futures for day trading. It's one thing that we like to trade because it's very efficient, very good liquidity in and out. And we'll take these little scalp trades. So that was good for $40 a contract. And, that's nothing to sneeze at. You do a few contracts and you can build it up pretty good. So again, this was what we call a cycle low. You can see it came down here. See this? These are what we call Heikin-Ashi candles, which also indicate trend. See the tops of these candles are shaven. You don't see any wick. So this shows a real solid trend to the downside. So this is a good way to trade off of a setup if you're looking for a long. When you get these really good moves down, a really good trending move down, then you're looking for a cycle low, what we call. And you can see the next candle here was engulfing, which was indicated by the arrow. And it was also a white candle, so it's indecision here. So this is a first signal that, okay, get ready. This thing might be starting to shift and might be starting to shift momentum to the upside. Now what we're going to be aware of, okay, so if we do get in, where are we going to get out? Because there's all these pockets or clusters of resistance that we're looking at. And so, there are a lot of different trade setups. So what I do on the NASDAQ 100 a lot of times, I will just set a fixed price target of 8 ticks, which is $40 a contract. And that's kind of the rhythm, of the NASDAQ 100. Each market has its own little rhythm to it. So, you want to find out what you want to trade first. So if you want to trade the S&P, the ES, or the YM, the Russell, or the Dow, then you need to paper trade it and figure out, what the movements are. So NASDAQ 100 moves in about 2 point increments, so that's about $40. So, if you get used to that, you can, pick off 20, 40, $50 a contract per trade fairly regularly. Now that's just a look at here a cycle low. So you just saw that trade set up, and so I'm gonna, when I execute, I'm gonna look at the 133 here, and I'm gonna look at the 200 here, and I want to see these bottom steady indicators turn up. So here we had a turn up here on the 200, we had a turn up here on the 400, and we had a turn up here on the 5-minute on the lower study, and this flattened out and started to turn on this indicator. So I was just looking to take a little bit out. Now, everybody has their different style or different way of trading. That is a real quick scalp, fairly quick scalp, for $40. But if you're looking at a longer term type of trade setups, then what we'll do is we'll move over to really kind of keying off the 5-minute time frame. So here's the 5-minute. Now the 5-minute time frame is one of the longer, the data stream for 5-minute data is kind of one of the oldest. When trading systems first developed, one of the first, the shortest time frame for data was the 5-minute. So most trading systems, a lot of them will be tested and modeled off, the old ones were modeled pretty much off a 5-minute time frame. Systems are still using a 5-minute time frame, for their modeling. So a lot of the high frequency systems will still look at 5 minutes. So you can see here, this is the NASDAQ 100. Now we have a lot of lines here, as you can see, and you might get a little bit frazzled by this. And with our studies, you can take off anything you want. You don't have to have it all up there, but I'm very comfortable and used to everything, so I know what it is. But so, showing you what this pivot, this is based on a prior day's trading range, and this is our pivot point, and then from our pivot point, we can calculate our Fibonacci levels, and the Fibonacci ratios and levels are, amazingly accurate. It's just so many systems are using these particular Fibonacci, projections and retracement levels that it's kind of like a self-fulfilling prophecy, and the markets really pay attention to these type of levels. So it's something that we've incorporated into our trading system. So from this pivot point here, you can see the first blue line here. This is what we call our support 2. This is based off of Fibonacci ratio. And you can see it also coincides with this red dashed line, which is the prior day's low. I always like to look at, for intraday trading, support resistance. So some of the key levels of support resistance for you to use is the prior day's high, the prior day's close, the prior day's low. You can also look at the prior day's open, but I don't find it as relevant as the high, low, and close. So here's our prior day's low. Here, this green line up here is, you can see it's the prior day's high, and right below it, right there, is support 1, which is a kind of a green line. So these things all line up together, and these are some other levels that we put in based on time. These dashed yellow lines are other time frames that we look at. So that's kind of the meat and potatoes of it. And then what I want to do is, here's a 5-minute lower studies here turned over, market lost momentum. So, this is a short setup. So right here, the short, if you're playing off the 5-minute, is, you look for a spike low down, so that bar there, and then what you want to do, markets usually will retrace back into these major resistance. You can see all this cluster resistance. This was your prior day's high, so it had a big spike down, retrace back up, and then what you want to do is try to capture a short on the break of that spike, that bar there. So on the 5-minute time frame, that was an excellent area for entry. And then you can see how it just trended all the way down. Now these are different moving averages that we use, and they're color coded to show change in slope. So this is one of the key moving averages. Here's another key moving average. And then right here, this is our oscillator band for what we use for our compression breakouts, these green lines here. And this is all color coded. So when you have a change in slope, the colors change. So it's a lot of information. It takes a little bit more time than just today for you to get used to it. But it's something that really can help your trading because it gives you the information that you need. So yeah, if you think it's way too many lines, it's easily taken off, but this is the way I trade. But if you don't want these lines, you can just go in and just go into your settings and take the lines off. So that's a 5-minute time frame. So then you can see that it came back down and turned up here. So had a long signal and used this prior low as your stop, and it's just consolidated here, had another engulfing bar here, and finally made a move back up. Now, by having these various support resistance levels in, it'll give you areas of, to take profit, to know that these are key levels of resistance. So you can see it came in right here to this red dash line. Now this is an hour low. So it came into the hourly low, pulled back, reversed, went short. So here's one really good trade. Here's another short little trade set up to the upside, and here was another short trade. So based on the 5-minute time frame, here's 3 really good trades for the morning. Now there are a lot more trade setups than that if you shorten your time frames, and you can have as based on shorter time frames. But if you're looking for a little bit more longer trend, the 5 minutes, the one that we will use just to stay with the trade for a more extended period of time. So now, and we also have our background. You can see it's turned green here. So when various parts of our model are in a long uptrend, the background color-coded thing that we use, which kind of alerts you. So you're just kind of visually looking at it, and then see here was black, and all of a sudden it goes green. Now it goes black. So different parts of our model will say, okay, it's going long, or it's not necessarily going long. It's just showing a potential for a setup for the indicators turning up. So there's a lot of information there. Now, the other thing I want to show you is I like to trade gold as well, and I like to trade gold specifically on these compression squeeze type trade setups. So I'm going to pull up gold. I'll show you the last trade on gold today that I had, and it was based on a breakout to the upside. You can hear those different indicators going off. Those are trend line breaks. We have automated trend lines here as well. So here's gold. Now what I like to do, the only trade on gold that I really like is when we get what we call these compression breakouts or squeeze, volatility squeeze. So I'm going to see if the last one I did was that broke to the upside. Let me pull up a different chart, longer term, to kind of show you what I'm talking about here. Okay, so these two charts, this is a daily, you can see that, and a 5-minute. Now what I like to look for, I was looking here earlier at the 5-minute time frame. Let's see, where was that? That trade came at 12:29. That was at let's see, 12, about 12:20. So right here, I'm trying to back up here and show you some of the things that. Okay, so what I was looking at, I like to go back through my time frames to see what's setting up. So here earlier on gold, I'm constantly looking for what we call these volatility compression squeeze type trades. So here you can see we're in a squeeze here, and at this was 5:30 this morning, broke to the upside. So what this is saying is that you're getting into a sideways pattern, and the market's either going to break up or break down out of this. So what I like to look for is a really tight pattern like this squeeze here. You can see this was earlier in the morning, and this is very typical of most markets overnight. They'll just go sideways like this, doing nothing, and then all of a sudden they'll break hard either up or down. So what I like to look for on this one, I would not have been in trading, but if you're overseas, what I'm looking for is this to break to the upside, and you can see the lower studies turned up, giving you the probability of direction of this breakout, and then I'll put in like an OCO, one cancels the other order to capture the breakout. So for example here, this was the trade right here I did a little bit earlier, and I just took $60 contract out of that. You can see here it broke, trigger to the upside. That was on a 15, and I was watching on my other time frames. That came at about 12:30 Central. So right here, right there. So I caught this trade right there based on that squeeze trigger off the 15. But that's not a really trade that is just stands out at you. The ones that are better would be like this hourly. This is an hourly time frame. So gold now is getting set for a big trade to the upside or downside. Right now it's showing it's going to break to the upside. So if you are a gold trader overnight tonight or sometime early in the morning, this thing's going to have a high probability here of having a nice move to the upside. So based on this, what I'd be looking at is a break. You can see here it's been in this squeeze on the hourly since 12 o'clock. That was on Wednesday. So this thing is, and see how tight it's getting? Really tight formation here. And this is what I love about gold. I don't look to trade gold on what we call cycle lows or cycle highs. I'm looking for these compression breakouts. So here we've been in the squeeze for almost a day and a half. So see how much tighter it's getting? It's like trying to hold a baby. Sooner or later, that energy, that baby's not going to let you hold it much longer, that puppy, and it's going to break hard either up or it's going to break hard either down. So the lower studies, though, are telling us that the probability is for it to break higher. So with this particular trade, what I can do, if I want, I can just set an OCO order overnight, good to cancel, and I'll put it here at about 12:30. I'll place it like at 12:31 right here, and I'll put it for usually 15 to 20 ticks. I'll go anywhere on gold. Gold's rhythm is about 10 ticks. That's $100 a contract. And if you get a good break out of this, you could easily get $200 or more on just the compression squeeze break to the upside or downside. So it can go either up or down, but right now the probability is showing it's to the upside. So I put an order in here about 12:31, 12:31.10, right above this pivot high extension. Leave it there. I set it for like 15 tick profit, and I set it for a 10 tick stop. and then one cancels the other, and boom, you can set that overnight and play it that way. Or if you're here trading, you can just watch it. So this is a trade you might want to take a look at. So take a look at this tomorrow. It's not something that's going to trigger today. It could, but gold is pretty much done here today. But this is one that, if you are a gold trader, these are really great trade setups. So take a look at this later, see if it does break and get a good, nice break to the upside based on what I'm showing you here, this compression squeeze. So that's a look at gold. You can do the same. Crude oil works actually quite well with it as well. Off these type of squeeze setups. Here's crude. So you can see crude, it's pulling up here. It's pretty slow right now. So here's our crude chart, and let me get rid of these lines. These are Fibonacci levels, just retracement levels, but I'll take these out. So what you're looking at here, just crude, here was a great setup actually for a top to the crude market. This is based on one thing. This is an engulfing candle here. So indicators hit that. Now, if you look, this is what I'm talking about. See this compression squeeze here? This is on crude oil, and this came at the top of the market. Crude had a nice cycle low trade here, and it had a nice trade into about mid-December, pulled back into all these moving averages, moved higher. Then the first thing to notice is lower steady indicators turning down on the daily. And then here's the hourly time frame. And this was on the 8th. This is January the 8th here. Let's see, this was on December 30th. So the market started rolling over longer term on the 30th and then broke hard on the 2nd. So I can flip back to the 2nd and see if there was a compression breakout. But right here, this would have been a great short trade setup. This came at 6 this morning. You can see how the squeeze, it's just consolidating sideways, and then broke. So what you want to do is, put your short signal right under this pivot low right there. And as it breaks, short it there or wait for a retrace back into this moving average and then short it. Put your stop above this candle here. So this is where it broke down. So you put your stop there and you would be short here. And you can see how the compression, these things are violent. They move really fast and hard. So here was a really good break to the downside. Our lower steady indicators had rolled down, so it gives you the indication of direction for these squeeze. And so you can just make a living trading these squeeze triggers or these compression squeeze. So that's on an hourly. So crude broke here on the hourly. That went from 93, let's say 60, and really didn't find a bottom until 92.20. So that's 600. That's 6, 7, 8. That's about $800 a contract right there. And then found a little bit of a cycle low, we can call it. Came back up, and then just rolled back over on another squeeze right here at 92.26. So back down into support level here at 91.70. So this 92 area is a key support, and we just penetrated it. Now, first time down on a major support level, it's usually going to bounce, so you don't want to short it right here. You're going to let it play out and let it retest it a few times and then short it. But you can see here, if you had been short, here's your target to get out. This pivot low extension, 91.77. So that's crude. Now, let me back up here to the second, see if we had any kind of squeeze on that as well. Yeah, there's the second right here when it broke down. Okay, yeah, see this? See this right here? This is the second. See the break? Here's your engulfing candle here. Now, if you've been trading week entry, you've got your compression squeeze here. These dots show when it started, and it shows when it ends, when it's triggered. So what you want to do when it's triggered, just go ahead and put your short on and use your stop. You know, whatever stop you want to use, but you could use the high of that prior candle, or, you know, depend on your money management, risk management rules, your stop, and then let it roll. And you see how that compression squeeze, you know, got tighter and tighter. And it's like a rubber band. You pull it back, or it's like a, you know, a spring. You push it down so much and so far, and then eventually it just, you know, breaks, and the energy of it's released, and it either powers it down or up. On this particular one, it powered it down hard. So that was a, you know, a really great trigger to the downside. So that's something I'm constantly looking at. Now, what I like to do for other type trades where I'm, you know, using options is I will use, you know, our scanner, and I'll look for these compression squeeze type trades over whatever market you want to trade, being NASDAQ 100 futures, Forex, futures, or just stocks or ETFs. And so, you know, what we'll do is we can use the scanner that we've developed based on this model, and it makes it easier to find these kind of compression type squeeze setups. So I'll give you kind of show you this real quick, and then show you a couple of different trade setups that I took here the last, you know, 30 days based on these type of trade setups. So here is our scanner. Now this is based on that same trading model that I showed you on the platform. And what this is able to do is highlight when you do start a compression, and highlight when that compression ends. So you can scan through stocks quickly, so you don't have to go through hundreds of charts at night. So here I've got, this is my special watch list. You can go here and you can put up anything. This is on Trades, on Thinkorswim, so I can go here and I can go to public, and I can, you know, look for, you know, futures, NASDAQ 100, Russell 1000, 2000, ETFs, whatever I want to look at. I can pull those up into my scanner, and it will scan every particular stock or ETF in there, so it can go through hundreds and even thousands. It might take a little time. Sometimes it gets a little bit clogged as far as the data stream. Now, okay, so here, then we've got it. You can break it down on a 1 minute all the way to a monthly time frame. Here's a monthly. So I've got it set to 1 minute, 5 minute, 15, 30 minute, 60, daily, 4 hours, weekly, monthly. And with that, I can then just take a look, and I can sort. I can sort by time frame. Here's 5 minute. Here's 15 minute. So what I constantly look for when I'm looking for like swing trades, I'll be watching the daily right here, the weekly right here, and the 60 minute. These kind of end the 30, but I'll primarily be watching the daily, the 60, and the weekly, looking for these compression squeeze type trade setups. So I can sort it here. Let's see. Okay, so here's the weekly. I'm sorting it. So what we're looking at here is when you see a green color here, we've color-coded this. This indicates a squeeze, and that's when the squeeze starts. You know, it'll turn green. Now we've also got this coded from a scale of 1 to 5, 5 being the strongest based on our model as to potential strength of a break or breakout or breakdown. So here, seeing if I see anything of interest right now. Here's a squeeze on the daily, and it's got a negative, so that shows the probability is possibly to the downside. That's on actually Tesla, TSLA. So this is my watch list. I constantly watch the same stocks almost over and over. So here's Tesla's in a squeeze on the daily. Here's right here, you can see this 4-hour time frame is a squeeze. That's on the Dow. I'll pull some of these up in a minute. I'm just kind of looking right now. Now the yellow shows that it's triggered. When it triggers, out of a squeeze, the color code is yellow, and it'll stay for about 3 bars after counter break up. Here's a squeeze potential to the downside. This is on SPX, so here's the Russell. I'm just looking to see here what I can find that's of interest. Here's crude oil. It's in a squeeze on the 30 to the upside. Let's see. Earlier, before I came in, I was looking for some things to go through and show you. Couple of them. Oh, BIIB. That's one that looked pretty good. Let me see if I can find that right here. BIIB. It's in a squeeze on the 5 to the downside. It's in a squeeze to 30 to the downside. On the daily, it's showing a potential squeeze. Well, it is in a squeeze with a potential break to the upside. So let's pull that up and see what that looks like. So I can just click on that. Clicked on that. Now that'll link to my charts. And here's BIIB. So now this thing is starting to trigger to the upside. Now you can see we're at 299.5. That's prior high. This has really good potential to, and think about this, it's barely down, and the Nasdaq's down 20 some odd. The Nasdaq's down 22 points, and this is hanging in there. So you can see how these compression squeeze, when they do trigger, it doesn't matter the direction of the broad markets a lot of time, they're going to go in their own direction. Now here's the trade here. I just noticed this today, but what I like to do is, if I'd seen this and I'd been following this trade, I'd be watching this. You can see it started on the squeeze here on the 31st of December, and then it's been in there for 1, 2, 3, 4, 5, 6 days. It's still actually in the squeeze right now, but it's triggered to the upside. So what I'm looking at here is, if you'd been paying attention to this, this would have been a buy right yesterday morning on this trend line break. See the trend line? Now that's another thing that I'm really keen on, is trend lines. We have these trend lines automated, and this one rolled off after so many bars that roll off. But this is one way that I would look to trade this. So I'm going to look at a pivot. See this pivot point here? So when you draw a trend line, you want to go from the right of your chart, most current price, back, not from your historic price down. So this is a Tom DeMark trend line rule, which Tom DeMark used to actually consult for the trading company that I worked for. He helped us develop a lot of our trading systems. So you go from this pivot high here, from the right, to this pivot high there, and then extend your line down here. So let me show you. So we have this automated, but it rolls off after so many bars. So see that red line there? That's your trend line, and that's from a pivot high to a pivot high. So you could have drawn it right in there, but you can see when it broke that trend line, see how that momentum really. So this would have been a great area for your entry off of BIIB. And that went, that thing just roared to the upside. That went from 278 up to 297. Now these things are crazy wild. Now the thing that I like to do on these type of trades is I like to use weekly options, and I like to do like maybe a bull put credit spread. And so what I'll do is I'll look when I get you've got to be focused though to catch these. But right here when it's breaking, that's the optimum time to sell a 1 standard deviation out of the money put spread. Or, if you're not worried about margin, you can sell a 2 standard deviation out of the money, just sell the puts naked. And you would have had, a 90% chance. If you sold 2 standard deviations, that's about 94% probability that it's going to close within the band. If you sold a 1 standard deviation, that's a 70% probability. And then if you have a trading system that's, let's say it's 60, 70% accurate, throw another 10 to 20% on that. So you have a probability of that trade going from 70% with your system showing you the direction up to 80 or 90, depending on the reliability of your system. So I can show you this quickly here. If you're not familiar with standard deviations, I'll show you just a little chart on that, bell curve. How many guys trade standard deviations on their options, use standard deviation rules and setups? You guys trade a lot of options? Anybody here? Okay. So the thing that you want to look at is the probability, right? So let me find that chart for you. Just bear with me a minute, and I'll show it to you. And you'll see it visually. It explains it pretty fast. So here's your old Statistics 101, normal distribution curve. And so what this is showing you, here's 1 standard deviation, here's the, so here you've got the probability that price will close between these 2 points is 70%. So that's why your market makers, the guys that are making the market for you, are constantly selling options, not buying, because they've got a 70% chance that whatever option they sold you between these lines here, it'll expire worthless. Now, if you go out 2 standard deviations, that's going to be about a 94% chance. So if you were, trading on this particular BIIB and you sold a 1 standard credit spread, and let's say right now it's trading at, when it broke out, let's see here, when it broke out at 279. So you can determine 1 standard deviation below, and let's just say for easy comprehension here that 1 standard deviation was $15, or let's call it $20 below. So that would be selling when it broke here the 279. You would have sold the 259 puts. So right here, listen, I'll if I can find the drawing tool, writing tool, I'll put that up for you so you can be more clear on that. Hold on. Here we go. Second here. Well, so anyway, let's call this 259 right here. So as long as BIIB closed above 259, you would just keep your premium. And the probability of that happening is 70%, okay? So then also, if you have your directional indicators pointing up, then that's going to increase that probability of that trade working for you. So when these things explode like this, a lot of times if there's good premium, I like to sell a put spread or something like that, 1 standard deviation out. So it's a great way to trade these breakouts. And it gives you a 70% chance, or actually higher, that you'll be successful on it. And that premium, even if it doesn't break hard and it just goes sideways, you'll keep that premium. Versus if you're buying an option, let's put it the other way around here. So if you go long options, you've got really, only if you buy that 1 standard deviation out, let's call that like a 15 delta. So those options might look cheap to you. So those options might be very cheap looking, but the probability of you actually having those options in the money at closing would only be like a 20 to 30% chance. So that's why you see the market makers selling versus buying, because they have a 70% chance versus having a 30% chance of winning. So these are things that I like to look at. and incorporate into my trading. So that would be one way to trade that, or you could have just bought, like a Delta 60-70 calls, which aren't going to deteriorate as fast, and you would have made a ton of money on that. So those are things that I love to look at. A couple trades that I'll show you while we're on this were some trades that I did back towards the close of the year, and a couple of them that set up really nicely were Cena and also Triple D. They were two really nice trade setups based on this kind of methodology that I'm showing you here. I'll pull up Cena right now. So here's Cena. So you can see here, we had a compression squeeze, and that was on the 30th. It started, the squeeze actually started here on about the 17th of December. And you see the price went up, but I like to wait until I see it starting to break. And so here it was still in the squeeze on the 30th, and then it actually triggered on the 31st. So I bought in right here, and I bought options. And on that day, let's see, I bought the 80 calls that expire actually tomorrow. And I actually took those off today, but you can see how explosive that move was to the upside. Now I'll be looking at the hourly here, and what I like to do is what I love is a setup where you have a couple of time frames in a squeeze, and then they trigger. It's kind of, if you can think of, like dominoes, when one domino hits the other, it knocks them all down, and that's how these kind of compression squeeze can actually happen. So here's an example of that. Let's see, we had that trigger on the daily on the 30th, and so if I'm looking back here, here's the trying to line this up for you. This is on the 27th of December, so I bought into this on the 31st. I went a little bit too far. Okay, so right here on the 31st, that was a Tuesday. This is when I put the trade on. And again, here's another trend line break. So what I like to do is wait for a trend line break. And you can see we had this one compression squeeze that broke on the upside on the 27th. Then it pulls back into your moving averages. And then it triggered again to the upside. So on this particular trade here, you can see you had another trend line break there. And it popped to the upside. It pulls back into the moving averages. This is a 50-period moving average, and it held. I was already long into the trade. Had a little heat. I bought the 80 calls. At that point in time, they were going for about 450, and that was about a 65 delta. And so $450 a contract. Now you could have done this as a spread as well if you wanted to reduce your risk. You could have done a $5 spread or a $10 spread, reduce your cost there, but I actually did both. And so bought those 80 calls. And you can see here, it just, once it triggered, I mean, it might pull back, but as long as it holds these moving averages, the probability is it's going to go higher, launch higher. And yesterday was, I should have taken it off yesterday, shoulda, coulda, right? But I thought I'd wait out another day. I didn't know today was going to be this big of a down day. And took those off today, and made on those, over $200 a contract. Yesterday I would have had $300-400 a contract if I'd taken it off on the high. So it's a good way to play these things, and it's a great setup when you are playing from a compression squeeze, especially if you're trading options, because I like to trade off the momentum, because options, you have that time decay. So if you buy into an option and it just sits and goes sideways, you're going to get faded out of that option, or it's going to expire worthless on you. So you need that momentum, and weekly options generate that great way to capture it if you can get the direction right. So what I've found in my trading, the best trade setups are from a compression squeeze breakout, because that direction powers momentum, and then I'll use weekly options to reduce my risk. You know, I can get a low-cost option if I want to buy it, or I can sell I can sell premium if I want to go that way. So I've got different options to take. So that was on CINA. Now, Triple D's been a really great one, and I'll keep going back to the well over and over with these same stocks a lot of times, just looking for these same setups. And here's Triple D. Question, buying at the money options. If I buy the options, I'm going to buy in the money options to take advantage of that not getting hit as bad with the time decay. Plus, also, if you get that breakout, it'll give you more. It'll give you more profit per contract, right? So, you know, basically, explain delta to you. If you buy a 60-70 delta option, so every $1 move on the underlying stock would give you whatever that delta is. So if you bought a 70 delta, you'd make 70 cents for every $1 move. So when I'm going long, I'll go long in the money. So at the money would be about a 50 delta. So I'll go long in the money, 60, 70 delta. And if the markets are real toppy, but still looking to break out, and if I get some premium, then what I'll do a lot of times is instead of buying, I will sell premium. So I'd sell puts or a bull put credit spread. So here was Triple D, and on this one I went long on the 19th, and these were for swing trades. And you can see here's this trend line, nice automated trend line here. So on the 19th, see that break? This was a perfect setup. You already had a trigger on the daily, and let me pull the 60. I'm constantly watching that 60-minute time frame with the daily and a weekly. Now, if you get a weekly, a daily, and a 60-minute, you've got potential for huge moves. So if you get a weekly squeeze triggering, it squeezes the daily, you can have some potential for some huge upside. And one really great way sometimes on the, is to use ETFs for that, because then you can get really cheap options. So, there's just a lot to it, but, and I cover all this, at Power Cycle Trading. If you're interested, I've got a lot of different courses. We constantly doing different educational boot camps on weekly options, swing trading, day trading. I'm going to be doing an earnings boot camp here in about a week. So if you're interested in trading stocks into earnings, you might want to check out, keep an eye on, make sure you sign up for my site, and we'll be sending out some information on that. But I love to trade non-directional trades. I've got a lot of different option trade setups for weeklies. I mean, using weeklies for earnings, you get, earnings, you get powerful moves, anywhere from 5%, 10, 15%, after release. So I like to do non-directional trades on that. So I've got some very good setups that I use for that. A lot of data and statistics that I use. So here's DDD. So got into that on the 19th. And let me pull back, show you the setup. So here was the setup here. So you can see here, this was a really perfect setup. I missed the perfect entry. Sometimes, I mean, you've got to be glued and really focused. But when I saw it squeeze on here on the daily and this trend line, this was, you just got to jump in. So on this one, what I did was I bought the, I should have just bought the calls outright and not done a spread, but I did the 80-85 call spread. So it's a $5 spread. I got into it for about $290 a contract. So $5 wide, my max profit's $210. Expires tomorrow, so I'll, have this trade full profit tomorrow. I'm just leaving on, let it expire worthless. So that was a great trade setup. You can see here, right here, you had a compression squeeze on the daily. You had a compression squeeze on the hourly. Look at this. This was just beautiful. So what I usually do is I'll do right here, I'll do bull put credit spreads plus buy options on something this powerful. And you can then, manage your portfolio, reduce your exposure. So let's say if you did some bull put credit spreads, you'll make money regardless. If it just goes sideways, you're going to make money. if you bought the options, you need it to go up, right? So what I'll do is a combination. I'll say if I want to spend $1,000, I'll maybe do 500. I'm just throwing out roughly numbers. Instead of doing all $1,000 buying options, I'll split that up into, say, maybe doing $500 worth of bull put credit spreads. So I have a higher probability, that 70% chance for that to win. And then I'll do the other 500, with some in the money call spreads or just in the money calls. So it's a really good way to diversify your whatever you're doing on that trade and to control your risk. So that was DDD. You can see it just exploded to the upside. Now that I'm looking at, let's see here, just to throw out to you so you guys can watch, might be something for you to follow. Let's see, CRM. Let's pull that up. So CRM, now you can see, let's see here, this is the it's in a weekly. So you can see it just started a weekly squeeze. So, keep an eye on, it's not something that I'm jumping into right now because it's not really ready to roll. But I just noticed this today when I was going through, scanning through things before I came in here. So CRM, something to keep an eye on, plus you're up at the highs. So it could consolidate, even today, it's down about $5. So CRM's something to watch. These are, you put these on your watch list and then you monitor them to see if they're going to set up. So I like to have them on my watch list and watch that 60-minute time frame, the 30-minute, and see if I get my setup. QIHU. So here's a good one. This is a potential for a break to the downside or upside. It doesn't really matter, but what it's going to tell you is that it's got potential to have a really good move. Now this is on a weekly, so right now the indicators are saying the probability might be for it to break to the downside, but it's still in the squeeze. It can stay in a squeeze like this on a weekly for quite a bit of time. So it puts it on the map for me, puts it on my radar screen. And then what I'll do is I'll monitor this using the daily time frame. Here's your daily, and then my 60-minute time frames. So you can see how this has just been trading just really sideways choppy. So it's nothing I'm doing here now, just watching. And this is another reason too that I like to do, say, maybe a bull put credit spread versus just buying the outright options. Because if I want to go long and it's just chopping like this, if I sell one standard deviation out or two, I still have a chance that this will expire above where I sold, and I'll keep that premium. Versus if I'd bought in here options, they'd probably end up expiring worthless unless they had that directional move that I needed. So this is something to keep an eye on. Bed Bath & Beyond. Now, another thing that to point out that I like to look at statistically or post-earning trades. Now this is one, wow. This is one on Bed Bath & Beyond. And this thing looked great to the upside. I actually went long this and then got stopped out on earnings. But what I do is I will go back through earnings history and I will put together a little database statistics to show what these stocks do after earnings if they trend. And this one particular, Bed Bath Beyond, will trend for, over the past 5 earning seasons, whatever direction it broke in, it trended in that direction, for the next 30 to 40 days. So with Bed Bath & Beyond, if you get a rally back up, you'd want to short the rally because the probability based on its prior statistics of earnings is that it's always trended in that direction. So earnings came out here, broke down hard. You can see it's off $9 today. So for the next 30, 40 days, based on past earnings, post-earnings history, this particular stock is trended in the direction of the break. So that's another thing that I like to look at. And I'll be teaching that too in this earnings course that I'll be doing in about a week from now. So keep in touch with me for that. So that was one that just broke down. So I'll be looking at this one. I was looking at this. It doesn't have much premium. I thought it'd have a little bit higher premium with the volatility, but if it pops back up tomorrow, I'll be looking to probably maybe sell a call credit spread, bear call credit spread. If it pops up much more than that, I might even be looking at buying some puts, but it had such a big move today that I'm going to wait and see if it gets any kind of push back up. But it should directionally trend lower or chop sideways and stay down here based on past trends. And one last thing, gold is looking interesting though from a longer term perspective. Yeah, options for sideways markets, I will sell iron condors. But you have to know what a good sideways market is now. And that's another thing, these compression, the volatility squeeze can help you on that. Gold here is something to keep an eye on. We've had a big move to the downside, as you can see, but I'm watching, for a bigger macro trend. I like to go through what we call top-down market analysis, and I'll start with the monthly time frame, and I'll go from monthly, which I call macro, to weekly, long-term, to daily, medium-term. So looking at gold, I'm keeping an eye on gold closely here, and if gold starts to show me and confirm that it's bottomed, then I'm going to, be loading up on, GLD ETF, and I'll go, maybe 6 months out, and I'll buy, go out on the calls looking for a big move. But you can see here this pivot low extension right here, this big move down. We came down here, retested it again. So keep an eye on this. This 1180 level here is a key support level. It's come down here on the weekly. It's tested it. I mean, it could easily break through, but it's something I'm going to constantly monitor hard, looking for a potential bottom. It's not ready to go yet, but it's something to keep an eye on because you're down at this low. If it does hold here, and then the rest of the shorter term time frames start turning up, this could develop in a nice, strong trend to the upside, a longer term trend. Now, if it breaks this area here, I'm looking for it to go back down here where it broke out the last time, right into about 1080. So these are the levels to watch. This support level here, 1180, and then another 100 points down to about 1080. But it's something to keep on your radar and just be watching. Right now, it's not ready to go, but you can see the indicators are starting to turn back up. And then look at the daily time frame. Indicators have turned up. It's got a lot of overhead resistance, but this could be the start, possibly, to this thing shifting to the upside. But you can see on the monthly macro trend, it's still pretty hard down. So, going to finish up here. Now, one thing I wanted to show you, if you're interested, this is a really good little course that I put together, and it'll teach you how to use support resistance. It'll teach you how to use Fibonacci for your extensions and for retracements. It's a great course. But the great thing about it is I'm making it very, very cheap for you guys today if you're interested. I have this listed on my site. If you went to my site, powercycletrading.com, the price is $127. I'll put the link up here. If Morgan, you could put it up for them. Okay, I think you'll be able to see it here. Hold on. Okay, so go to that link there. Now this is $127 on my site, but today I've made it a special price of $47. So it's a really great course to show you how to use. It goes through actually the psychology of market, trading plans, your 7 key points to put together a trading plan, moving averages to track trends, time frames to trade, using support resistance, Fibonacci and Fibonacci extensions. This alone is worth, the price of this course. And how to do the trend line breakouts that I showed you, how to draw those, how to use them, and how to identify market tops and bottoms using what I call top-down market analysis. So it's a great course for that. So anyway, I wanted to thank Morgan. It's got videos too. It's a 90-page course, 5 videos. So I think it's something that you guys could probably all get something out of. And thanks again for having me here today, Morgan. Appreciate it. It's always a pleasure working with you. I was disappointed, though, to see Auburn lose. Gosh, that was a close game, though, right? I know it killed you, but so goes football, but that was an exciting game. So any questions or anything before I take? Okay.
Thanks, Larry. Yeah, and Larry, you've got about 4 minutes if you have any if anybody has any questions.
Auburn covered the spread. More people now are interested in the football than anything else. It was a heck of a good game, though. Question: How do you predict direction? I will use my lower study indicators to use direction. And some of these indicators are lagging indicators, but when you combine them with different time frames and trend lines, you can get the great entry. So that's how I do it. But you need to, and I have my indicators are customized to certain settings that make them a little bit different from the norm. The course, the earnings course, it's not ready to be released. It'll be coming out next week. But if you register, go to my website and just opt in. I've got some free ebooks and everything. Let me just show you the website real quick. Let's see here. You go to my website. I've got some free ebooks and stuff, and just sign up for one of those, and then you'll be opt-in. You'll be on my mailing list, and I will let you know when that earnings course will be. It's going to. So somehow I lost that. Hold on. So go to powercycletrading.com, and now I lost my website. There it is. There's the link. Thanks. Okay, there it is. So just go to my website here. You can see it. I think it'll come back up. I guess it's not showing. And just opt in with one of my free ebooks, so you get something for free, and you'll be on my email list. And then you can, when I have that course coming out, you can sign up. I'll have a webinar on it. Great course, and I'll be teaching about 4 or 5 different non-directional option strategies for earnings release, and then for post-earnings trades, how to catch the trend after the earnings have released. There's some stocks that tend to trend, others do not. So, put together a bunch of good facts and stats on that you can use in your trading, and also option trading strategies for that, which will be, defined risk, fairly low cost type strategies. So that being said, thanks again, Morgan, and good luck with everybody trading tomorrow. And if you want to give me a call, please do contact me at PowerCycle. Just go to support@powercycletrading.com. Support@powercycletrading.com. Any questions? Feel free to send me an email. Thanks again. Ciao.